Right, so welcome back to accounting. We just looked at periodic inventory purchases, right? You need to purchase your items before you can sell them, right? Pretty straightforward, right? You need to have the inventory items available before you can sell them. So now here is chapter 6 where we talk about what you need to do when you come across some selling your inventory that is for periodic inventory, okay? We call this periodic sales. So, of course, as the nature of a business, right, we understand that our main goal of being a business is that we are trying to take all our natural resources and convert them into a product or service so we provide it to our consumers. And our main goal is to sell and make a profit. Okay? That's the main goal of businesses, is to make money. All right? And of course, what does this selling price include? Well, of course, when we look at costing the goods sold, so that's what we've seen before. How much did it cost me to sell my items, right? But that price also includes a profit percentage, okay? So for instance, right? I want to sell a mug. If I purchase it for $1.25 each, right? And I turn it around and I sell it out to my consumers for $5, right? That right there is a 400% profit. That is what I mean that I have to calculate. First off, what was it when I purchased it? How much did it cost me? So that, remember, when we talked about what the cost of goods sold includes, right? That includes every single cost it takes to get the inventory asset to your store. So that means that cost price will include the actual purchase price, the actual freight, anything that is involved, such as sales tax or anything like expedited fees, anything, because whatever it takes to get the item to your store, you're going to make the customer pay for it, right? You don't ever pay anything out of your own pocket to get those items to your store, right? Those are not separate costs that you have to incur just to operate your business, right? You're going to include that in the cost of the inventory item itself, okay? You're going to make the customer pay and cover that cost. Now, you never, ever do you want to break even, because when we go ahead and go dive into our our final class project where we're, it's called Coffee Cafe, right? That is where we're going to take a look at how we are going to be bookkeeping for a small business, and we're actually going to follow through, right? Because selling your inventory isn't the only cost of doing business, right? We have other expenses such as advertising. You need to market your products before you can even sell it. How do people know that you're even selling a product, right? You have to pay for the location, rent expense. So in this case, this profit percentage, your goal is you're trying to also have that price of selling the item be able to also cover the cost of operations. Okay, so that is why the selling price is made up of two components: the cost of the inventory item itself, plus a certain profit percentage. Okay, and that's going to vary between on how well your brand is, right? If you are creating the product, a unique product, then you figure out what is a good price point to sell your product to your consumers. If it's a product that's been made by some other manufacturer, so for example, you're selling, I don't know, detergent, right? You have Tide, you have Cheer, you have whatever the other brands is, right? All of those other stores carry those. So you're going to be in competition with those other stores that are also selling the same product. So how are you going to price your product to make it sellable? Okay, so that's where you're going to have to figure out what your profit percentage is. Now, in this class, that is not your job to do that. Okay, your job is not to calculate the profit percentage, right? Whose job is that? It's going to be whoever your sales representative is. Your sales team is going to be responsible for that. All you are responsible for is recording that a sale has happened, you collected the money, and you collected tax if there is any, right? In most cases, if you're going to sell a product in store, you're 100% going to be charging sales tax unless you are one of those 5 states that do not charge sales tax. And unfortunately, in the state of Nevada, we charge sales tax. Okay? So in that case, that is what you have to need to know when it comes to this portion of chapter 6 is about. It's just you recording the sales, the money that you collected, and the tax that you collected. Okay, all right, and of course we for this class right now the sales tax is in Nevada right now it is 8.375%, but I'm gonna make it quick and easy, simple for this class is just keep it at 8.25%. Okay, a straightaway number because sales tax varies depending on the city and county and the state that you are doing business in. Okay, I'm not going to talk too much in depth with sales tax because when we get into QuickBooks, that is something I will elaborate more on. Sales tax is made up of two components, right? State sales tax and your county and local agency, right? That is what makes up this 8.25%. Is a portion goes to the state and the other portion goes to the local agency or the local city agency. Okay, all right, so that is sales tax. But for this class, I'm only going to expect you to know that sales tax is going to be at 8.25%. Okay, make it easy, quick, and simple. So let's first go ahead and see what happens when we actually sell our products. So for this example here, on June 1st, 10 items were sold at $9.99 each. Okay, sales tax is 8.25%. Record the sales. Okay. So first off, we are going to be introducing to 2 accounts, right? You're going to be introducing to sales, which is your revenues, right? It's your way of earning money. And then we have a sales tax payable, okay? Now, a sales tax payable is not a revenue, okay? Because this money, the sales tax payable, when you earn this sales tax payable, this money is not yours, okay? What is sales tax? Why do we collect sales tax? It's so then that money can go towards the city and the state to, provide for the community. Okay, so in this case, why is it not revenue? In this case, because when we collect this money from our customers, we collect it and we owe it to the local city, state, and governments, right? So that's why it becomes a liability, because we don't pay our sales tax every single time we sell, right? We pay our sales tax either at the end of the month, at the end of the quarter. Maybe if you're a small business, you might end up having to pay at the end of the year. Okay? So sales tax, right, is not collected, when you make payments to the government. You don't make payments to sales tax on the daily, right? But you collect the sales tax from your customers on the daily, every time you sell a product. Okay? So first off, we're going to say that, well, how did you sell your product? Well, you either earned something, right? In this case, right, what if you're selling a product, your automatic assumption is you must be either receiving, number 1, money, okay? You sold a product. How do customers pay you? They either pay you by cash or they pay you on an account, okay? or you have an account with them, they charge a credit and then they owe you later. Okay, so it's either cash or accounts receivable. Since we are receiving money, right, that's going to increase our cash or increase our accounts receivable. Straightforward, right? What happens when you exchange a product for cash or you sell a product, right? Your automatic assumption is you must be receiving some kind of money, okay? We also have to recognize that we're going to increase our sales because in this case, right, when we are selling a product, right, we are increasing our revenues, right, because we earned our sales. So in this case, what is my sales? Well, if I sold 10 items at $9.99 each, straightforward, I multiply that together and that's going to give me a total of $99.90. There you go. I pop that into my credit side because I increased my sales because I sold something. Okay? And then second thing I got to do is I now need to also calculate my sales tax separately, okay? Why is this separately? Because again, this portion of the money that you collected from your customer doesn't belong to you. It belongs to the government. So in this case, in our books, we must separate it, okay? So in this case, we got sales tax is going to be based off the amount of sales, right? It's going to be prorated, right? It's going to be based on your total amount of sales, not the total items you sell, but the total price of your sales price. So in this case, I'm going to take my $9.90 multiply by that 8.25%, okay? If you guys know percentages, right? It's converted to 0.0825% or 0.0825, okay? No percent there. And then when you figure that out and you calculate it, you're going to get $8.24, okay? So that means that's $8.24 that you're collecting as that portion that the customer is paying for sales tax. And then, of course, at the end of the day, you should be receiving a grand total of $108.14, okay? In a real business standpoint, okay? If you are the retailer, right, and you're in charge of the cash register, right? The customer is not going to give you this. They're not going to give you money for the product and then they're going to give you the separate money for the sales tax, right? They're just going to give you a $100 bill and say, "Here, you figure out the change." Okay? That's why it is so important that on our end, this is what we have to do, because a portion of that money that we receive from the customer, we need to designate that a small portion of it actually goes to sales tax, because that is our job, right? That is our requirement that allowed us to be able to do business in the state and local agencies. That's why it's important to have to register to become a business between the local state agencies, so then we can set up what sales tax you need to be collecting and what are the things that you are doing in order to operate your business, right? That's the company's responsibility. Is if you're going to sell a product in my state and my city, you need to collect the sales tax and you're going to forward that money to me. Okay? So in this case, that's why in accounting terminology, we have to keep them separate. But at the end of the day, we're going to get a lump sum of $108.14. Okay? All right? Any questions here? Okay. So now let's go ahead and understand this. Now, because we sold a product, right? Because we're selling periodic inventory, right? This is all we record. We only strictly record the sales, but we don't actually record what we sold and update our inventory, because under the periodic inventory, right, we don't keep track of it. We don't keep track of what we sold, right? When do we know how much we sold? We don't find out until the very end of the accounting period, where someone goes down to the basement and they count their inventory and they tell you, hey, you have X amount of items left on hand. That means your assumption is you must have sold X amount of items, okay? Your job under periodic inventory is to not keep track of how many items you sold. So in this case, even though I know I sold 10 items, I don't record that I actually got rid of those 10 items. So that's the most important thing that you need to know under periodic inventory, is you don't keep track of sales. Or in this case, you don't keep track of the items you sold. You only keep track of just the sales and the sales only. Okay? And that is it for the first section of chapter 6. Okay? Now, of course, next section is going to be sales returns and allowances, because if you sell a product, right, you're always going to have somebody who doesn't like your product, who tried your product and it doesn't work for them. Because your goal is, when you're trying to sell a product to a consumer, right, your goal is to successfully get customer satisfaction. If that customer doesn't like that product, then your assumption is you have potential for a sales returns and allowance. Okay? Because again, any reasons for, let's say, for instance, they buy the product, it's broken, they come back to you, they want a refund. Okay? Of course, we sold the product to them, right? We have to issue them the refund because it doesn't work. Why would they buy something that doesn't work? Okay? Same thing with if they just don't want it. If it was a gift, right? Oftentimes gift exchanges, right? They don't like the gift. They come back and exchange and say, I don't actually like this present. I want something else. That is a very common one. Or another thing is they're just completely unsatisfied with that product. They tried it, they had high hopes for it, and it just doesn't work for them. They will come back to you and say, no, I don't like this product, period. Okay? For any reasons that you have a sales returns and allowances, it's going to be common, especially if you sell a product to a consumer. Okay? Now, of course, when we have those customers, we have to also create preventative measures to keep our products sold. Because what is our goal? Our goal is to sell our products and make a profit. If we allow our customers to come in and buy all of our products and come back and say, I don't want them all, give me my money back, then you're going to have a problem, because then you will never collect the money that you are trying to earn, right? So in this case, you have to create some kind of company policy that prevents your customers from making returns, okay? And some of those options could be a time limit, right? You can get your money back if you return it within 7 days, right? Another common one is 30 days, 60, 90 days, right? Because some companies believe that you should definitely try and test out the product for as long as you can. And then if you're completely unsatisfied with the product after 90 days, then you can go ahead and return the product back to us, money back guaranteed. Those are company policies for returning items, right? And other examples could be, for example, you can have things like store credit. So instead of giving the customers their money back, you give them a store credit to purchase something else in exchange. Other things could be a full exchange, right, for price by price, or maybe it's the same product but a different color. Those are usually acceptable. Other things that if you're for surely not going to want to give that customer their money back, final sale items is possible, okay? So for any reason that you do, have your company policy lay out these rules, okay? Then that will ensure that you sell your products to your customers and you get the profits that you earned, okay? But here's a rule of thumb here. If you do give money back, you also have to include the sales tax, okay? Why? Because the customer paid into it, so they get that money back, okay? Because it's not your money, remember. It is the customer's responsibility to pay their duties to sales tax to the state and local agencies, right? And if you did not sell that product to them, then you have to also give them their money back, okay? Because that's just the rule of thumb here, okay? All right. So let's go ahead and take a look at this example here where let's first sell an item first and then see what happens when we actually return the product, okay? So for example, here on May 1st, okay, you sold 50 coffee mugs for $5 each. Sales tax was 8.25%, and customer A paid with cash, okay, for these mugs. Record this transaction, okay? So first assumption is we're going to get cash, right? And second assumption is, well, we just sold a product, so therefore we're going to be increasing our sales, okay? And of course, sales taxes last, right? Now, how do I calculate this? Well, let's focus on our sales first. How much did I actually earn from this sale? Well, I sold 50 coffee mugs at $5 each. So 5 times 50 gives you $250, okay? And of course, the amount of sales tax I'm going to be charging is going to be based off of my sales price or based off my sales total. So in this case, I sold a total of $250. I multiply that by 0.0825, and that's going to give me $20.63 that actually goes to tax. Okay, so overall, I should be collecting from my customer $270.63. Okay, all right. Now let's go ahead and take a look at scenario 1. What if on May 10, okay, the customer A wants to return 10 of those coffee mugs for a full refund? Okay, and of course your company return policy is to give a full refund within 15 days, okay? So record this transaction. Now in this case, this is where we're going to be introducing to a contra account, okay? Because in this case, sales is final, okay? You can't undo sales. The only way you're able to record a return is by creating a contra account, which reduces the main account of sales. So in this case, here it is, right? Sales returns and allowance is a contra account. So in this case, why is it debited first? Well, if sales has a normal credit balance, this contra account, it's going to flow in the opposite direction. So in this case, boom, it is on the debit side, okay? So in this case, we sold the product, right? It was $5 each coffee mug, right? So we need to figure out how much sales returns we are going to be calculating here, right? We also have to give a portion of the sales tax money back, which we just talked about, right? And of course, customer A paid us in cash, so we're going to give them back cash, all right? So first off, $5 times 10 gives you $50, okay? And this is what I want you to do. I want you to take the sales returns amount, right? And I want you to calculate the sales tax off of this amount, because this is going to give you a quicker way to figure out how much tax money you're going to be giving back, instead of having to go through the whole process again saying, okay, I sold them 50, now I end up returning 10 of them, so that means I sold 40. What is 40%? What is 8.25% of the 40 mugs that I sold? No. This is much more easier, okay? This will tell you exactly how much money you are going to give back in tax, right? By just simply taking the amount that you're refunding, which is $50, multiply by the 8.25%, and you'll get $6. You get $4.13. Okay, so that means in grand total, you're gonna be giving back the customer $54.13. Okay. All right. And because you're giving back the money, right? Because it's a sales tax liability, right? This is us saying you're reducing what you owe, because now you're taking away the portion that originally that you put in your sales tax payable as something that you owe. Now you're decreasing it because you are debiting, you're giving it back. Okay. And that's it for the first section of returns. Any questions here? This is what you have to give a full refund. Any questions? Okay. Scenario 2, okay? Now this section here, right? As a small business owner, one thing that you have as an upper hand is you have the ability to haggle with your customers, okay? As a corporation, no. If the customer wants a refund, they get their refund. There's no questions asked. But for a small business, right, you're trying your hardest to keep customers coming to want to come back to continue buying your products. So in this case, for any reason that a customer does decide to try to, argue against you to get their refund, you can offer them additional discounts, because at the end of the day, you have bargaining power when it comes to sales returns. So that's why an allowance is possible for small businesses, where you can give a portion of the money back to a customer, right? And that's where the allowance comes from. So sales returns and sales allowances, they kind of more or less function the same way, okay? They are not the same accounts, but they do function in the same way, where a return is a full refund, where an allowance is a portion of the refund back. Okay, at the end of the day, it's still a sales return. Okay, so let's take a look at this example here, where on May 18th, customer A wants to return 10 of those coffee mugs for a full refund. Okay, but the company policy, once again, was that you can only return within 15 days. So they already missed that period for them to return the product. So of course, when they did that, right, of course, the customer was probably complaining, I don't like this item. I want a refund. I demand it right now. But what you can do is you can say, I'm sorry you missed the return policy date. What I can do for you is I can offer you a 15% discount off the product. I'm sorry, but you have to keep the product and there's nothing else, right? I can only give you 15% of the product because I already sold it to you. You can't return it. You already missed the company policy. So the only thing I can do for you is to give you a 15% discount. Okay, so there you go. Now let's go ahead and record this transaction. So because they were attempting to return 10 of those mugs, but we said no to them, but we offered them, instead of giving them a full discount, a full refund, we gave them a 15% discount. So we gave them 50% of their money back. So in this case, we're going to identify that we have a sales returns and allowance. Okay. Of course, we still have to give a portion of the sales tax money back. Okay. And we are going to give them cash. Okay. So first off, let's figure out what this allowance amount is, right? we know for a fact that we sold each coffee mug at $5 each. So they're trying to attempt to return 10 of them. In this case, that's $50, right? But I'm only giving them 15% of their money back. So in this case, 15% discount is only going to give them $7.50 back. Okay? And of course, sales tax, we multiply it by the sales price. So in this case, this is the amount that I'm giving back, right? It's not based on how many products I sold, okay? Not the quantity. It's based on the total sales price. So in this case, if I'm returning $7.50, that means I'm going to figure out how much 8.25% of that is, which is 62 cents. So overall, I'm going to be giving the customer back $8.12. Okay? Now in this case, again, a customer is going to be happy to get something out of you than nothing. Okay? So in this case, this is an allowance, right? This is strictly an advantage for small businesses because, again, we have bargaining power. We have the abilities to bargain with our customers. Okay? Yes.
When we return, and then some of the store only gives you a store credit for the final price they had that item, would that be the sales return? Would it be considered allowances?
If they did not go back and exchange, then yes, because a store credit would be a refund, right? It would be considered a refund because even though you're not giving them cash, right? You're gonna, instead of having cash, it's gonna be considered an accounts receivable.
Okay.
Because it's a store credit. They can come back and redeem it. You're not giving them their money back.
No.
Mm-hmm.
Oh, so that's the difference between returns.
Mm-hmm.
Okay. Because they can use it to buy something else from us.
Absolutely. And it's as if they had an account credit with us.
Okay.
Mm-hmm.
All right. Thank you.
Mm-hmm. Any questions on allowances? Okay. So again, that's why it is important that you do know this, that you can only refund for the amount that they're attempting to return, right? You cannot give them an allowance based on their entire sales, right? Even if they provide you the receipt, no. Okay? You can only give them a refund based on the total amount that they're trying to return. Okay? And that is it for section 2 of chapter 6. Okay. All right, last section here is going to be, of course, sales discounts, right? Sales discounts is going to be the greatest opportunity for any kind of business to sell their products because most cases, right, when you sell a product, right, customers are not willing to pay for a product for full price unless they're loyal to the brand, of course. Then what is another way to entice your customers to want to come and buy your products? Have a sales discount, okay? Common things is you go to the grocery store, what are they going to have? They're going to have a weekly ad of all the items that are on sale, right? And that makes customers want to go to the store and buy that product, okay? Now, again, you can also offer things like if you have a grand opening for your store, of course, that's a perfect opportunity to allow your customers to purchase your product without feeling too bad because they're trying your product, right? Other things could be a store-wide sale, online discounts, any kind of promotional, maybe for example, right, any kind of holiday that's coming up. So right now, July 4th weekend sale, that could be a perfect opportunity to take advantage, to market yourself, to have a sale so customers come in and buy your product. Because the next section that we talk about is what happens if we actually end up having too much inventory on hand. what happens to it when you don't sell your product? Okay? So in this case, that's the main goal. You never want to have too much ending inventory in your inventory, right? Because your goal is to sell out your inventory. And if you can't sell it, well, then the best way to try to get rid of it is through a sales discount. Now, mind you this, the sales discount means you're only discounting the profits, okay? Never sell your product below or equivalent to what it cost you, because then you make no profit out of that, right? You basically took a loss at that point, and you never want to do that, because again, at the end of the day, when you even purchase your items, they're probably really, really, really cheap. So you never want to sell your products that low. You want to still make some kind of profit, just as not as big, okay? But that's the thing about having a sales discount, is you're only discounting the actual profit you're earning, okay? You're still going to get a little bit of money out of it, but not just as much, because the purpose of a sales discount is what pulls people in to buy your product a lot quicker than if it were to just stay there on the shelf waiting to get sold, right? So in this case, that's what we're going to do. We're going to take a look at two ways that you can have discounts, right? One of them is going to be an in-store discount, while the other one is going to be other discounts that you can give for people who actually apply for an account or owes you money, okay? So the first one is going to be in-store sales. Now this one is going to be the most direct and easy one to do, right? So here, this example here on June 1st, right? Your store is having a promotional sale that all items are 40% off, okay? And a customer, okay, decides to buy 10 baseball hats, okay, with cash, okay? Which the original selling price for each hat was $10 each, okay? So in this case, sales tax is still 8.25%, and of course, let's go ahead and record this transaction, okay? So again, number one thing you should recognize is you're going to be receiving cash, right? Because that's what the customer paid you, right? However, you're going to get another contra account called sales discount, okay? If you ever go to a store, right, on the receipt, they have it exactly like this too. They have the original sales price. Right under there is a line item for the discount, okay? So this is also in real life terms too. When you're understanding in an accounting, you also going to have a separate line for the discount, okay? You're going to have the original sales, and then you're going to have a line for the actual sales discount. And then you're going to get the tax on that, and then you're going to get the amount of cash you're going to receive. So remember, sales tax is always going to be charged after the discounted price, okay? So that's important to know too. You cannot charge tax before the discount. Discounts first, tax after, okay? So in this case, let's go ahead and complete this. So if I originally sold all of my 10 baseball hats that are originally priced at $10 each, right? My sales is going to be $100, right? But because I have a sales discount, which is going to be 40%, 40% of $100 is going to give you a $40 discount. That means you should know you're not going to be getting all $100. You're going to only get 60% of that amount. So that's where you have to keep this in mind as well. So what you originally sold was 100 items. You discounted that price by $40. So that means your actual total sales at the end of this transaction is $60. Okay? Because remember, sales discount is another contra account to sales. So sales discount decreases the value of sales. So that means you have $60 worth of sales. That's where now I can charge the tax. okay? And that's where I got to figure out what my tax is. $60, right, is the actual sales after the discount. Multiply by the 8.25%, and you're going to get $4.95. So that means at the end of the day, you should get a total of $64.95 in cash. Okay? All right? How we organize it in our journal is slightly different than we would have reading a receipt. But the way that we calculate it is exactly like how we look on a receipt, right? We figure out how much was it charged, how much was the discount, how much was the tax, then how much did we get in overall at the end of the transaction. Okay? Any questions here? Yes.
So we are still giving a discount to customers, but the difference is when we are giving them a discount, that makes the difference.
What do you mean by when?
Like sales discount in store is we are giving them discounts when they are buying it. But in previous case, we are giving a discount after sometime after the customer bought the item. Is that why we are calling? Is that why we have a different names, or we are using a different account to record the discount?
Okay. Um, in this case, I think I know what you're referring to. You're referring to the next section. In this case, yes, this one's in store. This is at time of purchase. When someone purchases them, you give them the discount immediately because that is what your store is offering. You're offering the sales today, right then, right now. Okay?
Yeah.
Where the next section we'll talk about when we have customers who owe us on an account, we have the ability to offer them a discount if they pay within a certain time period. So yes, that part is separate for sure.
Well, I meant the so when the customer brings back the item
Mm-hmm.
and they ask for return, but instead of giving them refund, we're giving them a discount.
Okay. Yes. Because in this case, right, this is a store-wide discount. This means everybody gets the discount. In that specific case, right, it's considered an allowance because that one individual wanted to return a product, but you said no, and they're, arguing back with you, but you want to keep their business. So to make them satisfied with you, you offer them, hey, you know what? I will give you an additional discount just for you, just to keep you happy, right? And by doing so, then we call it a discount because that's in real life terms, right? You wouldn't say, I'll give you an allowance. No. You would say, I will give you a discount off of those items. But we record it as an allowance. That is different because this one is on a per case scenario. This one is because an individual is trying to return a product, but we said no. Where this one is a store-wide discount. Everybody gets the opportunity to take this discount.
Gotcha.
Okay.
But then when we are giving them a discount for paying it early, as you're saying earlier, that is the discount, but it's a different kind of discount.
That's another different discount, which is going to be the next section, yes.
Okay. All right, thank you.
So this one's for your customers that come into the store. Everybody gets the same opportunity to take the same discount. But of course, that depends if they're buying the item that is on sale, right? If they're buying an item that's not on sale, no. And then it's only on certain items that are discounted, right? You're not going to have the whole store discounted unless you have that offer deal. But in this case, right, this was specifically for just those baseball hats, okay? Or in this case, all items are on sale. And this person decided to buy hats. This one, that means everybody gets the opportunity to take advantage of this discount. Okay? Now, let's talk about the other one. The other type of discount that you can give to your customers, right? And we've seen this before, right? We've seen this before. We call them terms, right? If a vendor can give me terms, right? We can also give our customer terms as well. Terms is an incentive, okay? It's an incentive to tell your customers, hey, if you pay me back in a timely manner, I will give you an additional discount, okay? This is just a way to tell your customers, pay me sooner than later, right? And that's the offer is that, hey, if you do pay me back quicker, then I will offer you an additional discount. Okay? So this is an incentive to basically get your customers to pay you back quicker than later, right? That's all that this discount opportunity is. And yes, you can give it to all of your customers who owe you on an account because we call it terms. Okay? You can also be very selective about the people too, right? If it's a first-time buyer, then maybe you can give all your first-time buyers that opportunity, but any purchase after that, they just get the straight bill, right? They get the straight term saying it's just due in 15 days. That's the choice that you can make as a person who is offering this discount for someone who has an account with you. So that's the advantage here. Everybody could get the same opportunity, but some people might not get that same opportunity. You get to pick and choose. Okay? Now, in this case, right, let's go ahead and take a look at an example. Here on July 1st, a customer wants to buy in bulk 100 baseball hats, okay, from your store, okay, on an account. Okay? And because, okay, this customer is a first-time buyer, you decide to offer them some terms that if they pay within 15 days, they get the opportunity to take a 5% discount. If not, their entire bill is due to you in full in 30 days. Okay, so they get a time frame. They have 15 days upon purchase date to pay me back, and if they do, I will give them the discount. If not, the entire bill is due in full in 30 days. Okay? Now, again, it says right here that each hat was sold for $10 each. And of course, the sales tax is 8.25%. And you also added a delivery charge because maybe you didn't have all 100 hats on hand. So you offered them to ship it out to them, okay, which is an additional $10 charge. Record this transaction. So once again, how should this look? Well, we talked about how you're going to, when you sell a product, what's your assumption? You're going to be receiving cash or you're going to receive an IOU. In this case, an account receivable is an IOU. Okay? It's their means of having an account with you and saying, I will pay you later. Okay? So accounts receivable, right there. Now, in this case, we have to charge the tax first because in this case, terms is a condition, right? They have to meet the condition in order for you to take the discount. So our condition is you sold the product to them, but they have 15 days to pay you within those 15 days. And if they don't pay you, then they have 30 days to pay you upon the date that you sold to them. Okay? So in this case, this is a condition. I'm not going to be discounting them yet because it's a condition that must be met in order for you to apply the discount. So in this case, I'm just going to go ahead and record it as regular. Right now, what did I sell to them? I sold 100 hats at $10 each, $1,000. How much tax is that? That's $82.50. And of course, I also have to add the delivery charges there. Delivery charges is a separate charge to the amount. Now, in this case, most cases, delivery charges are tax exempt. You don't charge tax on them. Some cases, some companies do, but in this case, no. You're gonna charge them as a separate fee to ship them out. That's not included into their sales. Okay? So in this case, I only charge tax on the actual product I sold to them. And then I charged them a separate $10 for that delivery. Okay? So that means they owe me a total of $10.92.50. Okay? So then scenario 1, for instance, let's say that on June 12th, which is 12 days later, okay, the customer decides to pay us for what they owe, okay, in full, okay? So record this, and the terms was 5%, 15, net 30. So in this case, they did meet the discount due date, right? They paid within 15 days. They paid 12 days later, okay? So that means I have to give them their discount, okay? First thing I'm going to recognize is, well, they're paying me, right? They're paying me in full. And my assumption is I'm either going to be receiving a check or I'm going to be receiving cash, okay? I have to recognize that a portion of that is going to be discounted because they paid within the terms, the discount due date. And of course, because I charged them tax originally in full for the full amount, I also have to give them a portion of their sales tax money back. And I also have to reduce what they originally owe me. Okay? So in this case, right, what do I need to do? Well, I need to take a look at what was the original sales that I sold to them. In this case, I sold to them $1,000. That is the only thing that you can discount because that's what the terms is for. It's to only discount the sales price. Delivery charges is not going to be included as part of that discount because again, it's also for when we talk to our vendors, right? Can I get a discount off of my shipping? No, you can't. Okay, so in this case, we sold to them $1,000. So that means I'm going to calculate what 5% discount is off of those $1,000. So in this case, that gives me a grand total of $50. Okay. Now, out of those $50, how much money do I have to give back for tax? Well, 50 times 8.25% is going to give you $4.13. Okay? And of course, now how much money am I actually going to be receiving for this entire amount? Well, that's straightforward. You can either do one of the two things, right? You could take what he originally owes you of $10.92.50 and subtract out the $50 and the $4.13. Or you can also do it this way, right? If I sold to them $1,000, right, and then I end up refunding 50 of them for the discount, right? That means I'm at $950. And then I have to add whatever tax money I had to have, which was the $82.50 minus the $4, right? That's just more complicated if you do it that way. And of course, I have to add the delivery charges, and that's going to give me my grand total of the $1038.37. But the easiest thing that we can do here is we're only solving for one number out of the 4 accounts that we're using. So if we use our debit credit system, right, debits equal our credits, you'd be able to find the amount much more quickly, right? Instead of having to go through all of that numbers just to get to this number here, right? There's other ways you could still figure it out. I'm just telling you what is the easiest way to figure it out is, well, if you know that you're going to return $50 and then you're also going to give back $4.13, take it out from what the person actually really owes you. That's the discounted amount plus the tax money. And you subtract it out from what they owe you, and you're going to get that they are going to give you $10 $38.37. Okay? Any questions in regards to using terms to give discounts? Okay? Remember, this is a condition that must be met in order for you to record that discount. Any questions here? Okay, well, that's the end of chapter 6.1, 6.2, 6.3, right? We talked about sales. How do we record our sales, right? Straightforward, right? We have to receive some kind of income, whether it's cash, check, or accounts receivable, right? They owe it on to me on an account. Then we got to recognize sales, and of course, we got to recognize sales tax if there is any, okay? What happens when there's a sales returns? Well, you return the product, right? So you're going to record a sales returns and allowance. If it's a full refund, it's a sales returns, and you're just going to give them their entire sales money back. If there's tax included, then you have to return a portion of the sales money back, and however they chose to pay for it is going to be whatever you're going to give them back on. And of course, an allowance is when a customer returns something, but you give them a portion of the money, whether it's through a discount or not. Okay? We also took a look at what happens when we deal with discounts, right? In store, what do we do in store versus what we do when we give terms. Okay? All right. All right. Any questions in regards to 6.1, 6.2, and 6.3? Okay. All right. So then let's dive right into the chapter exercise here. Okay. For the periodic inventory, sales, returns, and allowances and discounts exercise. Okay. So, number one, journalize, assume that sales tax is 8.25%. Okay. So on April 5th, you sold a total of 100 cups at $5, each, okay, to customer A for cash. Okay. So, how should I journalize this transaction? On April 5th, you sold 100 cups for $5 each to customer A for cash.
We have cash flow debit,
Good, right? We
and
increased
then
our
we
cash
have
flows.
and we have sales and the sales taxable tax payable for credits.
Good. Okay. So what was let's first solve for what was my total sales?
It's 5 times 100 equal 500.
Okay. How much sales tax is going to be based off of that $500?
My calculation says $41.25.
Good. So in grand total, how much cash should I be receiving for this sales?
$541.25.
Good. Okay. And my description here is I could say I sold 100 cups to customer A. Okay. Then April 7, you sold 25 cups at $5 each to customer B on an account. And you gave customer B terms 10% 15 net 30. Okay? So in this case, you sold 25 cups for $5 each to customer B on an account. Terms is 10% 15 net 30. Okay? So how am I going to record this transaction on April 7?
instead of cash, we have accounts receivable for debit,
Okay.
and then we have sales and sales tax payable for credit.
Okay. So how much was the total sales if I sold 25 cups at $5 each?
The sale was $125 with a sales tax of 1031.
So how much
So
does
we have
customer B owe me?
$135.31.
Okay. And I'm going to make a note here saying that I sold 25 cups to customer B, and I'm going to put the terms here 10% if they pay within 15 days. If not, the entire bill is due in 30. Okay? Good. So then let's see what happened next. On April 10, you sold 50 cups for $5 each to customer C for cash. 50 cups at $5 each to customer C for cash on April 10.
Same as the first one on April 5th, but with the sale of $250.
Sales of $250.
And then with sales tax of $20.63.
Okay, so in grand total, how much cash should I be receiving from customer C?
$270.63.
Good. Okay. Then on April 15, customer A returns 10 cups for a full refund. Customer A returns 10 cups for a full refund. So let's take a look at that transaction for customer A, right? We sold to them on April 5th. How many items did we sell? We sold 100 cups, right? And they're returning 10 of them. Okay? All right? So, how should I record this transaction on April 15?
We use the contra account, sales returns, and allowances
Good.
for debit.
Mm-hmm.
And then we have to do sales tax and payable for also debit.
Yep, because we have to give the money back because we charged them sales tax. And how did
And then
customer... Go ahead.
oh, and then because they pay the cash, we use cash account for credit.
Good, right? They paid in cash, so we're going to refund them in cash. Okay? So, in this case, right, how much did I sold each cup for?
$5.
$5 each, right? I sold 100 cups at $5 each. So in this case, if my customer A is returning 10 of those coffee cups, right? What is my total sales returns and allowance?
So for the return itself is $50, but we're also giving them $4.13 in tax.
Mm-hmm.
So we are giving them grand total of $54.13 in cash.
Good. Okay. And I'm going to make a note saying customer A returns 10 cups for full refund. Okay, good. Then April 20th, Okay, customer C returns 25 cups but is willing to accept a 15% discount. Okay, maybe they missed the discount period. Okay, or I'm sorry, maybe they missed the return policy period. So in this case, right, customer C wants to return 25 cups but is willing to accept a 15% discount. So in this case, they came up to us, they say, here, I want a refund. And we said, no, you missed the company policy. Then they're like, well, I don't need these cups. I don't know what to do with them. So you kindly offer them a 15% discount, okay, off of these cups, okay, to ensure customer satisfaction, okay. So in this case, how do I record this transaction?
So it would be same as what happened on the April 15th.
Okay.
We used the allowance, sales returns allowance, and then sales tax payable for debit. And then since they also paid in cash, we are using cash account for credit.
Good. So in this case, right, what would be the total allowance here? If they're returning 25 cups but is only getting a 15% discount back, how much is the allowance going to be?
15% off of a 25 mugs for $5 each was $18.75.
25 times 5, okay, is 125 times 0.15 is $18.75. Good. Okay, they're only getting a portion of the money back for $18.75. Okay, what about the tax?
My calculation says $1.55 giving back.
$1.55 we are giving back. Okay, so how much in grand total am I actually giving back to this customer?
We are giving them $20.30.
Okay, and I'm going to change my description, right, because customer C, right, return 25 cups for, not for full refund, but for 15% discount. Okay. And then last but not least, on April 22nd, customer B pays in full for his purchases and meets the discount period. Oop, the discount. I keep fixing that, but it never, okay, discount. Okay. So if customer B pays for his purchases in full, okay, and meets the discount period, right? Let's take a look at when we sold to customer B, right? We sold to customer B on April 7, okay? The discount due date is going to be within 15 days. Now, what date is it going to be in 15 days after the 7th of April?
22nd.
He just barely made the discount period. So in this case, how much of a discount are we going to be giving to customer B?
$10% on $125.
Okay, so let's take a look at that transaction. So here's my accounts receivable, right? He owes me $135.31, but the total amount of sales that I had was $125. So that means I can only take a discount of 10% off of the $125. So in this case, how much is my discount?
$12.50.
Mm-hmm. Okay, so there you go. So let's figure this out. What is going to be, how am I going to record this transaction? If customer B decides to pay for his purchases, what's my first assumption that I'm going to make?
That he's paying wait.
Okay, he's paying. How does he pay?
We are assuming he's paying a cash in some form of a cash.
Okay, some form of cash, right? So I'm going to say cash, maybe he wrote a check, we don't know, right? But we received something. Okay? And what else, since we acknowledge that he has met the discount period, what are we going to recognize?
We are giving them a sales discount.
Correct, sales discount. And we are also going to be also giving back
Sales tax.
yes, because again, he's getting a discount. He's paying the items at a discounted price, not full price. We charged him full price for the tax on it. So in this case, we have to give a portion of the sales tax money back. And what is the last account that we're going to be recognizing?
Because he bought it on account, we are crediting account receivable.
Yes, we're going to reduce the amount that he owes me. Okay? So in this case, he owes me $135.31, right? We know the discount was off of the $125, right? So that gave us $12.50. How much tax money am I going to be refunding to customer B? Base of the $12.50.
It's sales tax on the discount we are giving them back, right?
Mm-hmm. That would be the easiest way to solve for it.
Is that $1.03?
That's what I got too, right? So in this case, how much should we be receiving from customer B?
The total $121.78.
Mm-hmm. 121.78. Yes. Okay, that's the easiest way to solve for this because then we're gonna look at how much he actually owes me, right? This is the full price of what he owes me. I have to minus the discount and minus the tax that I have to give back because he's gonna get charged for the discounted amount. Instead of having to go back through the whole thing and figuring out what that discount amount is and how much tax to actually charge, then we can solve for how much he's actually going to pay me, right? But if it's something a little difficult to understand why we get this number, let's show it to you in another way, right? So we originally charged him for sales, right? For 100 and here, let's do left side is your original amount and then the discounted amount on the right side. So in this case, right, We originally charged him $125, right? The sales tax on that was, what was it? $10.31. Okay, and that gave me a sub grand total of $135.31, right? Yeah, let me put this in here so you can see that this is sales, right? Then this one is sales tax, and then this is your total, right? This is the original amount. If I were to go ahead and recharge him for the discounted amount, right? 125 minus that $12.50 because he gets a 10% discount, right? How much is he actually going to be charged? Well, let's figure it out. 125 minus or times 90% is the same thing, right? So 125 minus $12.50 is going to give me $112.50, right? How much tax is going to be charged on that? Well, if I multiply the 8.25%, I'm going to get a $9.28. So that means in grand total, $9.28 plus my $11.12.50 $9.28 is going to be $121.78. Now, what's the difference between the two? Well, how much was the discount? Well, it was, $12.50? Plus, what's the difference between 1031 and 928? That is exactly $1.03. So there you go. At the end of the day, even if you calculate it this way, you would have gotten the same exact answer, right? At the end of the day, even though he paid it at the discounted price, this is how much the money is supposed to be. So therefore, he should be giving you $121.78, which is exactly what we solved for here, right? And we found out what the difference between the two was, right? The discount was $12.50. The difference between the two taxes was $1.03. Okay, so that's how we would visualize how we would calculate that amount. But in this case, the easiest way is just to take out what he truly owes you to begin with, subtract the discount, subtract the tax, and you'll get the money that he is supposed to be owing you, right? And of course, you need to make a record saying customer B paid in full, received 10% discount. Right? Any questions in regards to this exercise?